Welcome in, folks. It's a six-piece here today. Yeah, six-piece chicken for me to react to. Six little clips. First one up here, PPI came in, no bueno. Okay, we'll speak about that. Then we're going to listen to Jay Powell speak about those numbers and react to that one. Then I want to go ahead and react to this one, which is also Jerome Powell speaking, kind of give my opinions on that one. Confidence in inflation moving back down is not as high as it was. Very worrisome in regards to that. We'll react to this one here. The hard landing risk is always there, but it's decreased. Looking forward to getting in Gabriel Santos. Then Home Depot, they reported earnings this morning, so I want to react to that one. And then last one up here, this Amy Raskin selling Nike. Nike's a stock I'm buying very heavily the last couple months now at this point in time. So, you know, whenever I hear somebody selling a stock that I'm currently buying, I'm like, why are you doing it? Let's go ahead and hear that. Appreciate y'all joining me as always. Action-packed video here today. I'll ask in return. Make sure you hit that like button and make sure you're subscribed here to the channel if you're not already. Do you know like half of people that watch my videos aren't subscribed? Make sure you're subscribed. Let's get into this.
Earl, he is senior economist at the American Institute for Economic Research, and former Treasury official Kitty Richards, who is a senior fellow at Groundwork Collaborative. Peter, why don't we start with you, because you were anticipating that the numbers would be a little hotter than the consensus estimate. I think it's even hotter than what you were looking for.
Yeah, and I mean, to get right to the heart of the matter, it's clear to me that the Fed stopped raising rates too early. The Fed funds rate right now, policy rate is about 5.3%. Annualized core inflation, this is CPI, but 3.6%, which would put the inflation-adjusted policy rate at 1.7%. If you go to the Fed's website, they're calling the natural rate of interest like 0.9%. That's between 0.7 and 1.1, which suggests that top policy is too tight by between 50 and 100 basis points. But guess what? Prices are still rising, and for the past few months, they've accelerated. So I strongly believe that the Fed's estimate of the natural rate of interest is low by a few hundred basis points, and for that reason, U.S. monetary policy is still way too loose.
Kitty, I think you had the opposing viewpoint before we got these numbers today, the idea that higher interest rates weren't necessary to bring inflation down, but this kind of flies in the face of that.
You know, thanks, Becky. I think the thing to focus on here is whether the policy interest rates that we currently have are actually solving the inflation problem, or whether they're just causing pain for households and increasing the affordability problem. So, you know, if you look at inflation and CPI over the last few months, we do have a persistent problem in shelter inflation. And beyond that, inflation is pretty much under control. I think the big question is, do we need to see longer and higher interest rates? Or was this a supply issue all along that's working its way through? It is taking time. Also, there are huge corporate profits being pulled in that could come down in order to bring prices down. I'd like to see us talking about reversing the corporate tax cuts of the Trump era, rather than thinking about continuing to make it more difficult for families to buy cars, afford their mortgage, make their student loan payments, et cetera, which is the true direct effect of high policy interest rates.
Hey, Kitty, no argument that higher interest rates do make it more expensive if you're trying to get a mortgage, if you're trying to get a car loan or something along.
Thank you, Becky Quick. I think Becky Quick's going to take this where I think I was going to take it.
Lines make student loans, as you mentioned, but the reason for higher interest rates is to try and tamp demand in the economy, to try and slow things down, and that in turn is basically the only tool that the Fed has to try and rein in inflation. You say that inflation is only a problem when you look at housing. That's not the case. There's a front page story in the Wall Street Journal today that says that aluminum and cardboard prices keep getting more expensive, so do health insurance and wages, and as a result, small business owners are really getting caught in this trap, not knowing what to do and where to turn next.
So, have you guys seen the Small Business Confidence Optimism Index? Listen, guys, I showed this in the main channel video last night. I didn't even know the numbers were that bad. We're at the lowest level we've been in 12 years when it comes to Small Business Optimism Index. That's crazy. That's the least confident small business owners are, literally the least optimistic they've been in 12 years. I was like, oh my gosh, like 12 years? When you got to go back that far, that's tough.
I don't know what you think the tool is to bring down inflation if it's not higher interest rates.
Yeah, I certainly did not mean to leave the impression that the only problem in inflation is housing. It is, however, a huge driver of the inflation that we're still seeing. And again, I think the question is, is this tool effective and is it working? If we really have a supply problem that needs to work its way through, how much pain would we need to cause on the demand side in order to bring inflation down further? Recalling that it has dropped dramatically from its highs over the last few years. And so, it's really time that we think about, is this medicine causing more harm than good? Are the side effects worth the cure?
Katie, how does raising corporate tax rates bring down inflation and make it easier for families to buy goods? How does that work?
I mean, for one thing, it reduces the incentive for corporate profiteering. There are a lot of economists that talk about excess profits taxes in these times of, unusual supply restriction. We should also talk about the fact that we just have a corporate profits tax that we cut by 14 percentage points directly before the pandemic started. And that had to contribute to some of the corporate profiteering that we saw over the course of the pandemic. Also, the Fed has limited tools, but there's been a lot of talk about the fiscal side of tamping down inflation, and tax policy is a big part of that.
So, in all due respect to that lady, I think she's living a little bit of a fairyland. Okay, so let's say you go up on corporate taxes. First off, that's not going to do anything to help out the average Joe by going up on corporate taxes. Okay, it's just not. But let's say you go up on corporate taxes. Let's say we take it from 21 back up to 35 where it used to be, before T-Man was in office, right? Okay, we could do that. Do you know what companies are going to do? They're going to cut workforce. They're going to cut pay. They're going to cut salaries, right? You think companies are going to be like, oh, you know what? Our earnings per share went down a bunch. Our net income went down a bunch. That's okay. No, of course not. They're going to go ahead and say, okay, we'll do that. Okay, we got to cut pay here. We're going to cut stock-based compensation here on the employees. We're going to fire this many employees. We're going to lay off this unit, which is, when you add up what would transpire there across massive amounts of big public companies. If there's one thing we do know about big public companies, right? They don't just sit around if their profitability is going down and just say that's good enough. You know why they can't? Well, this gets into corporate structure then. There's what's called a board of directors, right? The board of directors comes under fire if the stock price goes down. Well, if your profits start to go down and down and down, guess what happens? The board of directors is going to potentially be voted out. So then they have to kick out the current CEO. They put pressure on them to make moves. If they don't see those moves being made, moves a la cost-cutting measures, cuts in pay, cuts in salaries, cuts in jobs, they don't see those moves being made, then new CEOs incoming, new executive team. Because if they don't, then the board of directors is out. And these board of directors, folks, a lot of them make anywhere from $100,000 a year to $250,000 plus a year to sit on the board of directors of these big companies. Some even, up to, I think, like $500,000. I tell you, they want to be there, collecting that money. It's not the hardest job in the world. It's actually like a part-time gig in regards to being on the board of directors of other companies. And so that's a lot of money there. They don't just want to get voted out. So everybody puts pressure on everybody. And at the end of the day, it ends up in job cuts. Okay. So that's the moral of that story. So, in all due respect to her, I'm glad Becky put the pressure on. And the other guy was his name, Joe. Because she was living in a little bit of a fairy tale, though. Next one up here. Fed's Powell calls PPI report quite mixed.
Producer price index reading just a couple of hours ago, and I would say it's actually quite mixed. The headline numbers were higher, but there were backward revisions, and we're of course disassembling it, taking it apart, and looking at it. And I think markets and analysts are looking at it as I wouldn't call it hot. I would call it sort of mixed. But in terms of the overall picture for inflation, I think you have to go back to last year where we had historically fast disinflation. Inflation came down by two full percentage points last year. Why did that happen? It's really two forces working together. One of them is just the reversal, the unwinding of the pandemic-related supply and demand shocks. So that we thought we would always get that. We thought we'd get it in 2022, and we didn't, and then it really arrived in 2021. So that was a big part of this, was just the reversal of distortions really to both supply and demand. The second thing is just restrictive monetary policy, and restrictive monetary policy cools the economy and makes room for the supply side to heal, but also lowers demand and ultimately lowers inflation. So I do think those two have been working together. And the question you ask is inflation going to be more persistent going forward? I think, and that would essentially mean that we've gotten the supply side gains that we're going to get, and now it's down to lower demand, which would take longer and potentially be more painful. I don't think we know that yet. I think we need more than a quarter's worth of data to really make a judgment on that. We know that there are still businesses still report that there are shortages and labor shortages and things like that, which are now being addressed. In addition, even when the shortage is alleviated, there should be lags before that shows up in economic activity and inflation. So there may be some more there. I don't want to give up on it yet at this point. I also think that, having restrictive policy, we have the highest interest rates in some time. I think that it may be that takes longer than expected to do its work and bring inflation down. I am confident that we will do that, but that we will get inflation down to 2%, and ultimately we will do what we need to do with our policy rate.
So, okay. What was the gist of that right there? Okay, I'll break that down into a few things. One, he's basically saying he believes rates are appropriate where they're at, right? He also believes higher for longer. So staying at these rates for a longer period of time. And that was basically the gist of what he said there. He talked for 2 minutes, but that was, it all came back to, you know what, we think rates are high enough. We're probably going to have to stay here for a while. But there was nothing there that basically gave a clue to, he wants to go higher with rates. It was kind of just like, we're at where we need to be, we're going to be here for a while.
Performing very well, a very strong labor market, households in good shape financially, and consumer spending and business investment are strong. Let's listen in.
The U.S. economy has been performing very well lately. We had growth last year of just over 3%, quite a strong year. And it's driven by a number of things. I would point to a very strong labor market where you've got rising employment, you've got rising wages, so disposable income, consumers are spending. Generally, households are in good shape financially. They're not over-levered. And so we see a good picture. Consumer spending has held up very well. As well, business investment has been strong. Businesses are seeing opportunities to invest, and that has helped. I would also point to a fairly large influx of immigration into the country over the past couple of years, and those people are joining the labor force. We're experiencing still a labor shortage in many industries, and so there are jobs, and they're going to work and they're consuming. So that's also boosting growth. So overall, a good picture looking at the data so far. The labor market is very, very strong. It was, I think, overheated a couple of years back. And
before you go further here, okay, I got to push back against this notion of households are in good shape when it comes to kind of their balance sheets and things like that, okay, because that can turn very quickly. The reason they can turn very quickly is because so much of an individual's balance sheet is many times made up of their home price, right? So let's imagine you actually get hit with a big recession, and let's imagine home prices fall, right? So suddenly you could go from a situation where, it looks like your balance sheet's fine because your house, which is most folks' big asset, right? It all of a sudden gets devalued 10, 20%. That could suddenly flip your balance sheet into a situation where now you're underwater on that home, right? And unless you've been paying off for a long, long time. So, because a lot of people do these very low down payments, some of them, do the FHA loans or they do other loans, where they only have to put 5% down or maybe 10%. And if all of a sudden home prices go down 15, 20%, next thing you know, you're underwater. And so then your balance sheet doesn't look very good. Never mind that, you tack onto a car that gets devalued in a recessionary environment, especially if it's a major recession. So that car loses a lot of value. So all of a sudden you're underwater on your car loan as well, right? Let's say simultaneously you lose your job, you're making $75,000 a year. You are able to go find another job, but not as good of a job. It's $55,000 a year. So now you're making less money. Suddenly your situation doesn't look as good. So when times are good, when unemployment's really low, people's balance sheets and assets are high, people's balance sheets can look pretty dang healthy and pretty dang impressive, right? But if all of a sudden you have weakness and you have home prices drop and car values drop and all of a sudden you start going through a deflation cycle, people's balance sheets get flipped really quickly, and then they don't look like they're in as good of a position. And then next thing you know, all that credit card debt they had taken out, that ends up not getting paid because they lost their job that was paying $75,000. Now they're making $55,000, and now it's either they pay that credit card or they pay their mortgage and their car loan, and they're going to pay their car loan and their mortgage before they pay the credit card debt. So then the credit card debt ends up going delinquent. You got problems with that, right? And so just a little food for thought in regards to that.
Is it coming back in gradually into a better balance over the last couple of years? And now I think if you look at a broad range of data, you could say that the labor market is about as tight as it was before the pandemic in 2019, and that's good. Wages real wages are now positive, and unemployment has been below 4% for 27 consecutive months, something that hasn't happened in a half century. So, labor market very strong, and again, signs of gradual cooling and rebalancing, so that supply and demand of workers is coming back into balance, just as we would want. Inflation, it's worth starting with the fact that on a 12-month basis, headline inflation got as high as 7.1%, is now down to 2.7%. Core inflation got as high as 5.6% and is now at 2.8%, so it's down by half. That progress, though, really happened over the course of last year, and particularly the second half of last year. The first quarter in the United States was notable for its lack of further progress on inflation. We had higher readings in the first quarter, and higher than we expected. We did not expect this to be a smooth road, but these were higher than I think anybody expected. And so what that has told us is that we'll need to be patient and let restrictive policy do its work. If I turn to the outlook just for a second, I would say we expect...
Important right there. That's basically Powell saying higher for longer. Higher for longer. Be patient on this. We're not cutting anytime soon. Don't get your hopes up about a cut right now because it's not coming.
Growth, 2% or better. We expect the labor market to continue to be strong, but to move further and further into balance. And I expect that inflation will move back down on a monthly level, on a monthly basis, to levels that were more like the lower readings we were having last year. I would say my confidence in that is not as high as it was, having seen these readings in the first 3 months of the year. So we're just going to have to see where the inflation data fall out. And I'll stop there with the economy. Thanks.
Higher for longer. Next one up here, Gabriel Santos. Tell us why the hard landing is not coming.
It was Justin Timberlake with Gabriel Santos this morning, Chief Market Strategist for the Americas at JP Morgan Asset Management. What do you think of him? The singer.
JT?
Yeah.
He has a beautiful voice.
Yes, he does.
Beautiful.
Yes, he does.
Good golfer.
And he's a good golfer.
Trolls.
Yeah. So, okay. Now we've gone off the rails. Gabriel, we've been talking about, we're going to get these PPI numbers later today.
That's
I
right.
think, and we're also watching, I don't know if we're calling this a melt up. What are we calling this in terms of what's happening in the market right now?
Well, we had a very brief 5.5% pullback for parts of April, and then almost a full rebound, less than 1% from all-time highs. So ultimately, I think it's just a continuation of the bull market here, the bull case. And I think ultimately, for the bond market, for the FX market, it's still very much all about what's happening with inflation and the exact timing of Fed rate cuts. But I think when it comes to risk assets like equities, like corporate credit, I think we've kind of moved on a little bit. There's more confidence in the base case, which is 2.5% growth, inflation that's normalizing over time, and a Fed in December and then again in May that took rate hikes off the table. And that's an environment where you can have great earnings growth and you can have a continuation of the bull market and very tight corporate credit spreads.
How concerned are you, though? We were talking, I'm trying to think who the guest was that mentioned this. When we think about a presidential cycle, if we don't know who's going to win, there's often a pullback in spending, both in terms of capital spending by businesses because they're not sure what's about to happen, and sometimes even consumer spending. Do you think that's in the offing or no?
I think What's been interesting is in terms of the bond issuance this year, we've had record investment grade, high yield issuance for this part of the year.
Right.
And we've been hearing that perhaps part of that may be taking advantage, that the market is open and doing it far enough in advance of the election. So perhaps that's already impacting certain decisions like that. But if we look at, for example, the Business Roundtable survey of companies, 40% of CEOs say they still plan to increase CapEx over the next 12 months. So I think it's very much an impact at the margin in terms of election decisions.
I wonder how much of...
So in regards to, okay, a few things. First off, if a CFO of a company or if executive team is making decisions based upon who might or might not be the president, they should not be in their role. You need to be running your business to be successful under any environment. Ask any top level great CEO ever, and they'll tell you, boy, you better run that business how under any circumstance. You can't be like sitting around and be like, I don't know if I'm going to buy some NVIDIA chips because I don't know if it's going to be B-Man or T-Man that gets elected. No, that's just ridiculous. You don't do that, okay? Second, consumer making buying and selling decisions, and pulling back whatever because they don't know who's going to be president. Stop it. Okay, just knock it off. If you think, the consumers out there and like, you know what, I don't know if I'm going to buy this latte or not because I don't know who's the next president's going to be. I like these Air Force Ones, but I don't know if I'm going to buy those because, I don't know who the next. No. Okay, that's No, that's just utterly ridiculous.
There's just so much liquidity sloshing around. I mean, the idea that you see a 5.5% pullback and all of a sudden everybody rushes in from the sidelines. What happened yesterday with the meme stocks, which is crazy to see that. I mean, this is a market that has plenty of liquidity, and maybe the Fed should pay attention to that too.
And we've talked about so much about the $6 trillion plus of cash in money market funds for a lot of people that were waiting for the hard landing last year, that were waiting for a more meaningful correction to get invested because they were afraid to invest at all-time highs. And I think what you're seeing is really just a capitulation. Look, the hard landing risk is always there, but it's really decreased. Overall, the base case has been underwritten, and investors want to participate in risk assets. So any kind of little pullback, you see investors.
Disagree with her. I actually disagree with her. I believe the hard landing risk has increased. Increased, not decreased. I believe the hard landing risk has increased. And the reason I believe it has increased is because we've been at, higher Fed funds rate for quite some time now. We're going to be here for quite some time to go. It sounds to me like Powell's kind of taken off even a summer rate decrease off the table. So that puts us likely into the fall before we even start to get rate decreases. And keep in mind, as long as things haven't completely fallen apart, they're going to slowly decrease rates. So that means we're going to have been sitting on 2 to 3 years of high Fed funds rate, right? Which is all going to weigh on the economy heavily, right? Which puts you at a much, much bigger risk of things going bad rather than if you just got it done and over with quickly, right? And then when the Fed does actually, let's say the economy really starts to go off the rails later this year or in early 2025, and let's say the Fed then starts to cut aggressively, right? At that point in time, Fed lags once again. So it's going to take you a year or two to catch up with the Fed kind of easing there. So it's not like it happens overnight. So therefore, I actually feel like the hard landing risk has increased, not decreased here recently. And with inflation still not defeated, that also makes me feel like, dang, man, this was the moment. Like right now, it should be the moment where we had defeated inflation. It was donezo. We were in the twos already. Fed could be looking to cut this summer. Basically, if we had already defeated inflation by now, it would almost be a guarantee that Fed would start cutting this summer, keep cutting into the fall, keep cutting into the winter, right? And then I think that was a situation where we could say, okay, maybe we're going to get out of this one without a major recession or something like that. Now, with inflation still problematic, that makes it a lot tougher. So a little food for thought in regards to that.
buying equities, but also buying corporate credit and buying international equities as well.
I know it's not something you focus on, but what do you think of this whole GameStop situation all of a sudden coming back in the marketplace? Does that say something more broadly about where we are?
I think it says a lot about the psychology and the investing behavior of different generations. And I think it's really interesting to see that, especially for millennials, for Gen Z investors, there's a lot more focus on the short-term investing behavior.
It's kind to call it investing. It's kind to call it investing.
Exactly.
Trading and gambling.
It's trading, it's gambling, it's quick payoffs, instead of, look, we're investing for 5 years, 10 years, which is ultimately the time horizon we should have for equities here. So I think a lot of that is a reflection of a new generation of investors.
No. Baloney. As somebody that runs the private group, right, and I get to hear from folks and I get to see, who watches the channel and those sorts of things, right? You're always going to have a certain amount of gamblers in the market. You've always had a certain amount of gamblers. People just throwing money around at whatever they think the hot thing is, and ultimately people usually lose money, right? There's still a lot of people focused on exactly what I do, looking at the fundamentals of companies, actually staying focused on building positions in great growing companies that have great long-term opportunities, have real business models with real profits, real revenues. There's plenty of those folks out there. We got 1,000 plus of them in the private group. There's a ton of you guys that aren't in my private group that watch this channel, and you're focused on building your portfolios and on the long-term investing game. So, I just will always push back against that notion of just thinking like, the millennials or the Gen Z or whatever, they're just into gambling. No, there's a lot of those folks that are into gambling. I live in Vegas. It's a city built on gambling, right? But at the end of the day, there's a lot of people focused on the fundamentals of companies, long-term investing. And I think a lot of those folks are the most educated we've ever seen in history, just to be quite frank, in regards to really understanding how the market works, really understanding valuations and financial statements and those sorts of things. Certainly much more so than previous generations, in my personal opinion, because of the access to information. You just didn't have all this before. You didn't have ability to learn from people on social media or just on the internet and things like that, and get into these very complex subjects. You didn't have the ability to run through courses and all that stuff. And so, and even the softwares, that exist today that are much more advanced than anything previous generations had. So, yeah, there's always going to be a certain amount of people that want to gamble money around. By the way, before we get into those last two, I got a brand new workshop for you guys. I recorded this last week, 7 Steps to 7 Figures Plus in Stocks. If you're somebody that's into long-term investing, really focused on the long-term game, you're going to love this video here. It's going to take you through each step to reach $1 million plus in your portfolio. I'm going to teach you growth hacks that I learned so you can scale faster, and then how to implement those 7 steps to achieve this big number. Okay, free access to that. That is the pinned comment down there. Alrighty, next one up in here. Let's talk about Home Depot's earnings, and then we'll get into Nike.
Analysts, and I think, Brian, you figure the stock recently has been a little weak after a pretty good rebound after some prior weakness, but you don't think it's cheap here, given the fundamentals?
Well, good morning, Joe. No, I don't think it's cheap. That's really the reason, one of the key reasons why I remain on the sidelines with Home Depot. I mean, in my view, I've said for a long time, this is a very well-run, well-positioned company for the longer term. But I believe, and I think we're seeing these numbers again today, that these cyclical pressures, which I very much view as post-pandemic, are continuing to weigh upon Home Depot, and I think will continue to weigh upon Home Depot basically through 2024. I don't think that dynamic is yet in the stock price.
I don't really understand what that means. You mean that people did things during the pandemic and they used up all the demand for what they were going to do at that point, so that's still a post-pandemic, what did you call it, cyclical issues or something? So it's just all, they moved it forward. They've already done some of the stuff that would be happening now if they hadn't done it. They got the boost during the pandemic. Is that it?
Yeah, I'm sorry. I'm trying to say something creative and lump lots of stuff together. But so look, I think, and it's debatable, right? I mean, I guess we bottom line this. Here, same store sales for Home Depot today were down, just to make it simple, roughly 3%. Okay, normally, the normal growth algorithm for Home Depot would be, +3, +5. Okay, so we're tracking significantly below what I would consider to be a normal growth algorithm for the Home Depot. So why is that?
Now, there's obviously multiple factors at play. I still think one of the biggest factors is the amount of demand that was pulled forward into the pandemic.
Yeah.
So that's when Home Depot sales were tracking up 25%. We were all sitting in our homes, we were building decks and.
So I don't have any put options on Home Depot, but this is why it is brutal sometimes to bet against stocks, because you're looking at Home Depot and they missed on comp store sales, which is usually the most important metric many people look at when it comes to retailers. They missed pretty bad, and yet, man, look at the stock. It's not down. You think, stock has to be down 10%. It's just not, right?
Shaping and doing everything else. And it's just going to take a while to get past that boom in demand.
We've gone back and forth on inflation with Home Depot. Lumber prices, I guess, help. But now I'm seeing that higher prices for the big ticket items just makes demand softer. Are you seeing actual consumer, I guess you'd call it elasticity, based on higher prices?
Well, it's difficult to say. Because if you take that, like what Ted said in the press release today, he talks about ongoing weakness in demand for bigger ticket items. Okay, so that very much could be the consumer pulling back somewhat in a tougher consumer spending environment, holding off on that purchase of that bigger ticket item. That very much could be a play. But again, I think another piece of this is that there were a lot of bigger ticket items purchased during the pandemic. There's a normal kind of break cycle for these items. We're just not there yet. So again, it's a mixed bag. Now, the other part with inflation, I think
before we go further here, when we're talking about that, it's like, okay, somebody's still going to Home Depot to go get some nails and a new hammer, but they're not going to Home Depot to buy a new refrigerator, right? Big ticket.
Very interesting. So you mentioned lumber prices. Generally speaking, on commodities and other maybe more mundane items, inflation's generally been a positive for Home Depot because Home Depot has been very, very good at passing that inflation along to consumers. So that inflation in and of itself becomes a sales growth driver.
Okay, so that makes sense. So now it's up, now it's down. It's been around 340, 341 is where it closed. The high is almost 400. I guess that's probably an all-time high. Would you buy this long term? What do you have an objective down the road?
Yeah, I would buy it long term, but I'd be waiting. This is what I tell our clients: wait for a better price, okay? Because I believe that look, the way I think that the market's going to absorb this data point today or this report today is that it's one more softish report from Home Depot, and I think that makes the second half 24 rebound that a lot of people are still waiting for less likely. Okay, I think that's going to be the takeaway again as the day progresses. But my advice to clients is, look, you want to own a Home Depot at some point, but you want to be price sensitive here. Not to get too technical, but right now we're trading at 23 times earnings. Okay, I think that multiple should be something less than 20. Something less than market multiple at this point.
Agree.
I think that's where it gets attractive.
So what does that get you to? What's a price target that you think is an attractive entry point?
250.
Yeah, so I've established in my recent reports at Home Depot, I've established what I call these downside targets. So the range I have published out there right now is 260 to 290. Now that's a ways off of the current price, but that's what I call.
He's still too high. 225, 250.
As that's your plug your nose and buy Home Depot. All also saying you're buying Home Depot within that range.
You plug your nose, or you
plug your nose and buy it.
Oh, okay. I don't think you want to necessarily plug it as if you're really, you got to do
it.
Well, you got to do it for a while. Hold it. You can, you're flexible for when you. 274.
Okay. Alrighty. Next one up here. Nike. What's going on?
Because we're pretty active in the investment committee. Amy Raskin, I start with you. You sold Nike.
Yep.
Seems to me from the notes here that you've had it.
I've had it, yes. Well, we trimmed half our position, which we spoke about a couple of months ago, but we're done. The company's just not executing as well as it should. The brand is still great. We could come back to it at some point, but they're not executing right now. China's a risk for them, and so we're out of the position.
So stock's down 14% year to date.
Yep.
Down more than 20% over a year. They certainly have had what I think people would suggest is an innovation slowdown.
Yep.
company sort of acknowledged that. They blamed remote work.
Which was terrible. I mean, yeah.
For that.
Right. Their competitor somehow figured it out
Hoka,
during remote. Right.
New Balance.
Right.
So you can sort of go down the list of names that
Aloe, Lulu,
feel like are rising competitors.
Taking share. Yeah.
That's all.
Yep.
They're all sort of
fair.
part of the sell pie.
Yep, all part of the sell pie. I really did not like the explanation that we couldn't innovate over Zoom. Everybody else sort of figured it out. They've just made a bunch of missteps. And hopefully they'll come back from it, but I see no signs of that right now.
Okay. So I want to get a comment, Josh, from you on this. You know, this is obviously one of those, these blue chip brands that, man, the stock just has done terribly. I know you don't own it, but I'm sure you have some thoughts regarding Amy getting fed up and just saying enough is enough.
I feel like there are a lot of stocks right now just like this in the market, and we're seeing this happen one by one. It really reminds me of Starbucks. And, you know, I was talking to someone who was pulling the trigger on Starbucks because it's a great brand not executing, just like this situation. And my comment was like, look, there have been 5 turnarounds-ish that I can remember just in the last 10 or 15 years in that company. But typically, you have time because they're not a one-quarter phenomenon. So what's plaguing these companies, I think, is just fatigue on the part of the consumer. In some cases, prices are too high. In other cases, they're being out-executed or there's more creativity at a competitor, which is, I think, what's going on here. But regardless, it typically takes more than one quarter to turn a ship this big. So I would say I don't disagree with Amy saying, you know what, I need to move on and do something different. And for those who are looking at this as an opportunity, you might be right, but don't think that it's going to happen right away because these things take time. So that would be my stance here. I have no position, nor am I particularly running to get involved here, regardless of how much it's down off the high.
Amy, you also sold.
Okay, so, you know, Josh Brown, JB, he brings up a good point there, right? You know, it's not like everything magically turns in a quarter. He's 100% right? You know, if you're talking about getting the business in a better and better place, you got to execute that over a year, 2 years, right? And that's a perfect example of like a Nike situation where I'm looking in back half of the years when I start to see some results and then obviously start to see major results in 25 and 26. So he's 100% right. But the one thing I'll push back on is you don't have forever. Because as soon as things start to get a little better, guess what? People start to pile in the stock. And next thing you know, the stock's 100, 105, 110, 120, 130. And so as the story gets better and better, the stock reflects higher and higher and higher. So you don't have forever. So that's why I'm building my position now. Do I expect everything to just be amazing next quarter? No. But I'm of the understanding that I've got to get my position built this year before it's clear things have really turned around. So, you know, that's the name of the game in regards to that. Appreciate y'all. Hope you enjoyed today's video. Thanks so much for joining me. Once again, pin comment down there, access that workshop that's going to help you out immensely. Much love and have a great day.